Hi, everybody. Welcome to the Middle Class Investor. This is Seth Martin, and it is Monday, May 19th. I'm recording on Monday today because I just didn't get to the recording this weekend. It was kind of a busy weekend and it took a lot out of me. So, anyway, recording on Monday. As you can see on the screen, I've got our familiar rising wedge. We've talked about this pattern before, and I think it bears mentioning again, probably, that the thing that makes the rising wedge unique, what's really happening, I guess, is the way to look at it, is that if you think of this line right through here as the mean, the average of all the price action as it's moving up through this wedge, think of above the mean as the market being overvalued and below the mean as the market being undervalued. And think of these lines as just where traders, extremes occur, where they say, nope, the market's way overvalued up here and the market's way undervalued here. And so as time progresses, these distances from the mean to the upper and lower bounds, they get smaller and smaller and smaller. And if you just think about it intuitively, think of it like profit margin. As this narrows, as this consensus narrows, it makes it harder and harder for people to make money. So here, maybe they're making 100% return on their money in these trades, and then here they're making 90, and here they're making 80, and here they're making 70 and 50. I mean, I'm just making these numbers up, but you can see as this narrows, your ability to make money as a trader becomes more and more difficult. There's more and more risk in trading this undervalued, overvalued scenario. So what tends to happen is people step to the side. They say, you know what, I'm just not going to trade. And then that's why volume, if you look at volume in the market, and we can do that real quick. We can go look at volume real quick in the Dow. I think the Dow shows volume. Let me turn it on real fast. You can see that over this time period, hopefully you can see here that the volume has basically been declining. And this is very typical of a very typical outcome of the scenario I just described. So as time goes on, it gets harder and harder to make money. Traders, they become less and less active, and this price action narrows, and the volume drops off. And you can see today, even though today, well, that's not really today, that's this week. So let me pull up today, because I'm seeing something here that's kind of interesting. If I can get the right chart up. So you can see today, even though it was an up day, the volume was lighter than the previous day. And in general, what you do is you just kind of watch this volume, and if you see a really big down day or a really big up day, the volume, whichever way the volume moves in that direction, that directional part of the market, it's usually it's a very subtle sign, but it's a sign that traders are becoming more and more aggressive in that particular direction. So you can see right here, this was a pretty big volume day right here, and you can see, in fact, let's just zoom in a little bit on this. That was this day right here. This is an inverted hammer type of formation. It's usually pretty bearish, and you can see you kind of got some real sideways consolidation that happened around here. So it's not unusual really to see a lot of volume on a day like this. So what happened is the market opened here. The bulls pushed it all the way up here, and the bears came in and pushed it all the way back down here and then closed here. That's a pretty bearish day. And if you go analyze this volume for that day, you'll find that a good percentage of the volume, a high percentage of the volume, is downward pressure. And maybe that's a good way to think of the market, is just pressure. Which direction is the pressure pushing? Is it pushing to the upside? Is it pushing to the downside? And this pressure, the aggressiveness which bullish traders or bearish traders push the market, will over time change the direction of the market. So that's all we're looking for. We're looking for these signs, these subtle little signs, to give us clues as to how aggressive or how non-aggressive we should be positioned in the market. And that's what I'm trying to help you guys with. A lot of people don't look at the market this closely, and it takes a lot of time, and there's somewhat of a feel for it, a feel for how the market moves. And most people just don't have the time or even the interest to really stick with it that long to really learn those things. So this is one of the reasons I created the YouTube site, is just to help people, get a bird's eye view of what's going on, and not have to dig so deep. I do try to explain some things so that I'm just not making things up, but at the same time I'm just trying to share with you kind of what I see. And guys that I learned from basically always said, look, you got to trade what you see. So you can't trade what you think, you got to trade what you see. So I realize you guys out there are not traders necessarily, but the same still applies. So let's get our S&P 500 back up there, and let's talk about something that's interesting here. Since this last corrective, this was actually a correction, with respect to the pattern, it was pretty significant, right? Because it sold off from the extreme high of the pattern, from up here all the way down here. So in that sense, it was significant. It touched, or nearly so, touched the upper bound and touched the lower bound. Really, since then, we've been trading within the pattern and haven't really tested either of the edges of the pattern, which might indicate, it's hard to say what that means. It may not mean anything, but it might indicate that even traders are uncomfortable letting the market. Let's say you're short, okay? You're short, you got short right in here. You're a trader and you got short right here. And the market's trading down, it's trading down, it's trading down. And all of a sudden, right about in here, you're saying, okay, it's time to get out of my shorts and go long or step to the side. And as more and more people do that, the market doesn't actually make it to the lower bound. It stops short and reverses. And this kind of stuff happens as you start having this tighter and tighter action from the mean. So it's not really unusual to see that, and I'm not so sure that it indicates anything other than we might not see this actually get to the mean again. We might going forward, we might only see, let me zoom in again, and whoops, that's not good. So I lost my chart. There it is. Sorry about that, y'all. Just having a little difficulty here with the buttons. Anyway, let's zoom in here and let's look at the most recent price action. So here, this was the most recent correction, and notice that, here's what's interesting. This is what I think is so interesting about the market. Look at the shape of what happened here. You basically have this, okay, and this is how the market corrects, just like this. You have this overlapping fashion. And then here we can see that it did essentially the same thing, just with a smaller range. So you can see that these sections these areas in the market are very different than these sections. You see here you have this strong thrust up and then this consolidation. Here you have a strong thrust up and then this consolidation. So this is kind of an interesting thing because it's really showing the fractaling nature of the market. The market tends to fractal, which just means that it tends to repeat its pattern but at smaller intervals. So this is a smaller interval than this is back here. And if we were to go back further, there'll be another one of these, but a larger interval back here in the beginning. So, which leads me to why I have these red lines drawn on here. This is another rising wedge that is occurring within this rising wedge. Now, the reason this is significant kind of goes back to what we were just talking about, how here we went to the lower bound. The market basically sold off until you got to this undervalued area in the market, and then it reversed. Just like here, they bought the market up until it got into this overvalued area, and then they sold it off. Now you've got kind of that same situation occurring, but even a smaller range, a range that's much, much smaller than this range. So what does that mean? What now should we be looking for if this rising wedge is our bound? Well, the same thing we were looking for back here. I mean, these, with a high degree of accuracy, these tend to resolve themselves to the downside. Now, obviously, if it breaks out of this to the downside, it might only get down here to the lower bound, and then bounce, or it might break through down here into the support, bounce, and test the underside of the lower bound of the rising wedge. We don't really know. All we can do is really watch. But what's interesting is this move, even though it's small, notice it was pretty strong. I mean, we had a this is called a shooting star. So the price, it moved fairly strong, consolidated, and then we had this little throwover area, and this candle here is kind of a shooting star candle, which, we've talked about these shooting stars before, but essentially you've got, let me zoom back in. I just try to get some of that stuff off the page. You can see the market went up. It opened up here. The bulls ran it up. They ran it just outside this boundary, which is interesting. And then the bears pushed it all the way down, and then market resumed that sell-off until it got here. It actually overthrew to the downside before the bulls pushed it back here to close it, and then reversed it. So to me, this is very interesting. This could be what I always look for is the first move down or the first move up. Any kind of first move you're looking for, and then a consolidation. So let's just take a look at that real quick and see if we see something. So what I'm going to do is I'm going to go to a smaller time frame, because essentially what we do. Let me cover that real quick. Let me go to a larger time frame first, and let me zoom in, and you can see here the extreme week. So this is a weekly chart. Each one of these is a week. Each one of these bars is a week, and the extreme week is right here. So that means that our resistance is off of this high right here. So our resistance area is like right in here. It's actually drew that too close. It's so small that it's actually kind of hard to draw. The resistance area is just above. Well, it won't let me do it. This charting software. So anyway, and then the support area is just below this low. So here's where the market is wanting to trade. Okay. Now we're going to switch to a daily time frame. And so let me move this box now that I've got a little bit more resolution here. So normally resistance is like right there. And maybe it's closer and it actually hit the resistance. Resistance and support are zones. They're not real hard lines. That's why I draw a box and not a line. But it appears that the market shot up off this low, came up into resistance, and then this could be the first move down. So what I look for when you look for a trend reversal, if this, for example, was the first move down, then we would look for some sort of corrective pattern. Here. So if this was the first move down from here to here, then what we would be looking for is something like this on the way up. Okay, this is corrective. In other words, when you have if you notice this is corrective, but then if it's followed by a corrective kind of looking pattern, then that could be signaling that the next move is down larger than this one. Usually 1.5, 2 times larger than this one. So what I'm interested in is I'm going to go look at this move down, and then I'm interested to see if this looks like this. Okay, but because this is so small, it's on a smaller time frame. It's a fractal of a different time frame. We have to go down a time frame and look at it. Now, normally, look, I mean, this is not something I suggest you do. It's hard enough to follow the markets on a daily and a weekly basis. When you start talking about intraday, that complicates things even more. But I do want to show you potentially what could be here. So you can see this was a pretty strong move down right here, which, I mean, look at that right in there, especially right in here. And so the question is, is this area right here corrective? So, maybe I don't know, can you see it kind of looking like that maybe? Does that look corrective? So if it is, tomorrow and the next day should really reveal something. So if this is in fact corrective, then we should see a pretty strong move Tuesday or Wednesday, so May 20th or May 21st, something like that. So I'm going to be looking for that very carefully tomorrow on the 20th, because when you have, if we go back out, we look at this, let's say on a 3-month. If this is the first move down and this is corrected, the next move down could come into support, or maybe even through support, and then break this support. Now, then we're going to be looking for a corrective move back up to the underside of this rising wedge. So this is going to be, since we see this rising wedge within this rising wedge, I'm starting to think we're going to start to see some action. I mean, we could see some action break out to the upside, but usually a rising wedge resolves itself to the downside. And if it breaks out of this other rising wedge, then obviously we've got some pretty serious downside action coming our way. And this is the type of thing that we want to keep you out of. If it doesn't do any good to make all these gains and then just turn around and give them back to the market. I mean, you got to give some back. Some drawdown is acceptable, but a significant amount of drawdown, 30, 40, 50%, those are the types of drawdowns you really can't recover from as an investor. So, and it can really slow down your path to retirement. So we want to try to the extent we can keep you out of that, we want to try to avoid those situations. So let's just, while we're here, let's just go ahead and look at a couple other, let's go back to a weekly chart. And let's go look at some of the other items that we've been looking at. So the 10-year interest rate, we've been keeping an eye on the 10-year. The 10-year, as I've mentioned before, is a pretty important benchmark. And so one of the things that looks like has happened here and since we were just talking about it, let's just continue that conversation. This, in the context of the larger trend, looked like the first move up, okay? This actually, I mean, it could actually be here or here. And then this looks somewhat corrective. I mean, you can see all the overlapping action here. There's just a ton of overlap. That's usually corrective. Just like as we moved up here, this was corrective of this last little section here. As you moved up here, this is corrective of this. So, but if this is the first move up and this is the correction, now maybe the correction lasts longer. Maybe it bounces here and then comes even lower down into this area. I doubt it, because the only reason I say so is because the only reason I think it won't come lower is the Fed. I think traders are going to look for opportunities as this moves. In fact, I think they have been looking for opportunities to get out of the bonds and sell them to the Fed. The Fed's buying, so as the market's been moving down, I think traders have been, hey, the Fed's buying bonds, we'll sell them our bonds, which is, it's just another bailout, by the way. It's just a different kind of bailout, and potentially very damaging to the economy, to each and every one of us as citizens. So if this is the first move up and this is a correction into that move, the next move could take us well above. In fact, let's look at 10 years. So you can see I've kind of got this 31 zone here marked. But if we lose this high, in other words, this breaks out above this, the next stop is in this 4% range, and then of course we'll get a pullback, and then the next stop will be in this 5.5% range. So this move in the interest rate is pretty. I mean, if you go back, it's been going down for a long time. Interest rates have been going down for a long time, and this last little move right here looked like the last move, and all this has been, has looked more like the market's trying to bottom. You kind of get this curving pattern and then starts taking off. Interest rates follow about a 30-year cycle, and if you go back and look at this, if we look at all the data, you can see that here in 1981-ish, the interest rates peaked at 16%, it looks like. A little bit more than 16%. And they've been going down ever since. Now, obviously, we know this. The market doesn't go straight down. So interest rates have been falling for 30-plus years. And it stands to reason. Usually interest rates don't get this low, but it stands to reason, as low as they've gotten, and the fact that we're at the end of a 30-year cycle, it's a high probability that this is a bottom. And this is going to have a tremendous amount of damage. It's going to do a tremendous amount of damage to the market. Rising interest rates hurt stocks. And the reason is people can put their money, they can make, well, at this level right here, they can make 6% interest on their money without having to put it in the risk at the stock market. And so people do that, especially, older people that need yield, people that need income. So this is the tug of war that is the bond market and the stock market, okay? Let's go back to, let's look at a 1 year. Let's look at the euro US dollar, which is actually trading right now as we speak. It's at, you can see it moving over here, maybe. I don't know if you can see that or not, but the euro has been pretty strong. It looks like this 140, if you go back a ways, the 140, if we go back 10 years, you can see it's been kind of grinding its way lower. And you can kind of see this looks very corrective to that, right? And then this still looks corrective. I mean, this whole thing almost looks sideways. But if this latest correction, Let's zoom in a little bit. If this latest move is a correction to this move, in other words, if this is a correction, and this is a pretty big correction, right? I mean, this is covering years, okay? Then what we could expect is something pretty significant like that to the downside. Something that would take out the old low back here that happened during the 2011-2012 euro crisis. We could actually see the euro trading at parity to the dollar at some point in the future, which would be very interesting. Probably see a lot of, if that happens, you're probably going to see, you're probably going to start hearing on the news how Europe's putting in this trade barrier and that trade barrier, and the United States is going to, follow through with their trade barriers. And this is how trade wars get started. When people kind of get used to certain things, and then things change with the money, they start trying to protect their own interest. The other thing that I wanted to look at, we'll go to a 5-year and look at the NASDAQ. The NASDAQ has been weaker, although today it was fairly strong. In fact, let's look at a 6-month. So today you can see it's pretty strong. Now the NASDAQ, it's moved down. It broke through support and then found support at this latest, this previous correction here. So here's the new support line for the NASDAQ, and you can see that it's been consolidating, kind of correcting off this move here. But if this is in fact a consolidation, we can expect the NASDAQ to be moving lower here pretty soon. It might, if you notice the 50-day moving average, which is this blue line, this is pretty typical. If you go look at charts, you'll see the market break through a 50-day moving average, what we call retest it, break down below again, and then you'll see this maybe touch the 50-day moving average tomorrow or the next day, and then that's going to be a real critical point. Will it go through it, or will it bounce down from it and come this way? So we'll be looking for those types of things. The last thing I want to mention is just the YouTube channel. This is it right here, the Middle Class Investor. This is what it looks like. So when you're looking for videos online, you'll look. I've been kind of posting this as a thumbnail just to give it a little bit more recognition, so it's easier to spot online. But here are some of the videos that I've posted previously. But if you look for this little symbol here, which is a bull and a bear, and then you look for this red and black chart, that's the Middle Class Investor YouTube posting. And of course you can, if you go to, after you watch the video, you can go to the share button and you can share with people on your Facebook, you can share with people on Twitter, you can comment. There's a place on here where you can comment. It shows up in the discussion. Nobody's been commenting, but I'd encourage you to comment, ask questions, whatever you want to do. There's a little about section. This is just something that shows up if somebody's searching online. Back to videos. These are all the videos. So anyway, just you can follow me on Twitter at InvestorClass, or you can go to YouTube and watch the videos. You can also just copy the link. You just go up into your web browser and hit the button and copy, and you can email the link to somebody if you want to share with them. Hey, listen to this guy. Sounds like he knows what he's talking about, or whatever. So anyway, until next time, thank you for visiting the Middle Class Investor, and watch closely the market. I think the next week or so is going to be pretty telling. And if a lot of things start happening in the market, we'll come on and make videos more frequently, maybe a couple times a week or something. All right, thanks for visiting, and until next time, we'll see you when we'll see you. Thank you for visiting the Middle Class Investor. Take care, everybody.